Hi, my name's Christian Waldegrave, Head of Research at Teekay, and this is our tanker market update for April 2023. Well, looking back at the first quarter of the year, it was another exceptionally strong year for tanker rates, especially in the Aframax and Suezmax sectors, which was a continuation of the strong rates that we saw in Q4 as well. And the strength in Q1 was really driven by two main factors. Firstly, we've seen that Russian crude oil exports have continued to be very strong, even though the EU ban on Russian oil imports and the price cap of $60 per barrel came into effect on December 5th of last year. In fact, Russian crude oil exports have increased in the first quarter of this year, averaging about 3.5 million barrels per day compared to around 3 million barrels per day in the second half of 2022. And furthermore, all that oil is now moving long haul into India and China, predominantly on Aframax and Suezmax tankers. So that's really stretching the mid-sized tanker fleet and creating strength in mid-sized tanker rates. Now, Russia did announce a production cut of 0.5 million barrels per day from March onwards, but we really haven't seen that impacting export volumes, which suggests that maybe their production cut was more to do with reduced domestic demand and lower refinery throughput rather than a desire to cut exports. The second factor that has been propping up tanker rates is an increase in long haul movements from the Atlantic to Pacific. And that's really been driven by a couple of things. Firstly, we've seen Chinese oil demand and oil imports start to pick up after they abandoned their zero COVID policy at the start of the year. Although we think there's a long way to go in terms of increasing Chinese demand and imports, but it's definitely been a positive factor at the start of the year. And also, we've seen very high US crude oil exports. So in the last few weeks, US crude oil exports have averaged about 4 million barrels per day. And in some weeks, they've been over 5 million barrels per day. And furthermore, the price of US crude has been below that of other grades such as Brent and Dubai. So that's made US crude very attractive to European and Asian buyers, which has driven a lot of ton miles and longer voyages. So again, that's been very positive for tanker rates. Now, looking ahead, we do think that those two factors will continue for the next few months in terms of firm Russian oil exports and more oil going from the Atlantic to Pacific. However, there are a couple of potential headwinds on the horizon. Firstly, the OPEC Plus group at the start of this week announced a surprise production cut of over 1 million barrels per day. And that did come as quite a surprise, and it could have a negative impact on tanker demand in the next few months if it translates into lower seaborne volumes. However, it will probably impact the VLCC market more than the Aframax and Suezmax markets because most of the cuts are due to come from the Middle East. In addition, with the Middle East cutting production, again, that could make Atlantic-based crudes more attractively priced, and therefore Asian buyers might look more to, say, US or Brazilian oil, which again should support the longer haul voyages and the ton miles. And then lastly, if we do get OPEC production cuts in the next few months, that should coincide with rising oil demand. We still think that oil demand is going to show strong growth through the year, particularly driven by China. And so that should cause oil inventories to deplete pretty rapidly. And then by the end of this year, we could be in a situation where OPEC may have to start increasing production again to meet rising demand. The second headwind that we're facing potentially in the next few months is in the global economy. We saw in March a couple of smaller US banks went under, and Credit Suisse had to be bought out by UBS. And there's a fear that that kind of banking crisis, coupled with stubbornly high inflation, might cause a more severe slowdown in the global economy. It does seem for now that the banking crisis does seem to be contained a little bit. We haven't seen further contagion, but there is a chance that this could get worse in the next few weeks and months, and it's certainly something that we're going to keep an eye on. But for now, at least, we still think that we might get a mild recession in Europe and North America, but those weren't really expected to be the main drivers of oil demand growth this year anyway. We still think it's going to be Asia and China in particular as they come out of COVID. And the economy opens up and more people start flying in and out of China, that's really going to be driving oil demand this year. So in terms of our outlook for rates over the next few months, we would expect that spot rates might moderate going into Q2 and Q3. And that's not unusual for the summer months. There is a seasonality to tanker rates. Q2 and Q3 seasonally are normally a little bit weaker. And this year that might be exacerbated a little bit by the two things I've just mentioned, the OPEC cuts and a slowdown in the global economy. But overall, we think that, for the mid-sized tankers at least, the predominant factor is still the fleet being stretched by longer haul Russian exports and longer haul US crude exports. So we do think that tanker rates will still stay very firm through the summer, well above the long-term average, but possibly a bit lower than what we've seen in Q4 and Q1. And we think we'll go into another strong tanker market again this winter. Looking even further ahead into the next 2 to 3 years, we still have a very positive long-term outlook on the tanker market because of the positive fleet supply fundamentals. We have seen a little bit of additional ordering of tankers during Q1, but not at a level which makes us too worried about the outlook. And it's the overall pace of ordering, I'd say, is still fairly low, with owners being deterred by high new building prices and a lack of shipyard capacity, with most berths for 2025 now having been sold. So looking at our forecast for tanker fleet growth, we do see fleet growth moderating to about 2% this year, and then negligible levels of fleet growth in both 2024 and 2025. And so for those reasons, we still believe that we are still in the early innings of what could be a multi-year upturn in spot tanker rates. So that's our tanker market outlook for April, and we'll speak to you again next month.